A very good afternoon, everyone, and thank you for joining the JKH Investor Relations webinar for Q2 2023-24. I am Gihan Kure, the Deputy Chairperson and Group Finance Director. I am joined by the Chairperson, CEO Krishan Balendra for today's webinar. The format for today's webinar will be where Krishan will take us through an overview and some of the key highlights of the JKH performance for the quarter and some of our key projects. And thereafter, I will take you through a presentation covering the key financial aspects of the performance for Q2. And then we will open up for questions and answers. If you have any questions, please enter your question at the bottom of the tab, at the Q&A tab at the bottom of your screen. Thank you. So with that, I'd like to ask Krishan to commence proceedings by giving us an overview. Thank you.
Good afternoon, everyone. Thank you for joining this investor webinar. I'll start with a quick snapshot on the macro. The economy continues to stabilize. Most indicators continue to improve. We have seen inflation coming down sharply to very low single digits. The Sri Lankan rupee has been fairly stable at around 325 to 330 to the US dollar. There was an announcement of a staff level agreement with the IMF a few weeks back, and a final board approval for the next tranche from the IMF is expected quite soon. The next key event on the macroeconomic front is the debt restructuring with our external creditors, and all indications are that that is also progressing well. The government has also called for expressions of interest for certain privatizations, hotels, the airline, and some other businesses, which we believe is also a very positive development. And we would encourage the government to expedite some of these privatizations. We've also seen an increase in electricity tariffs. In this context, the new Electricity Act, which has been approved or which has gone to Cabinet, is a welcome move, where the Act envisages the unbundling of the Ceylon Electricity Board, which should allow for greater competition and better tariffs. The budget is, of course, next week, and that is much anticipated. On the ground, from the business front, we have seen a gradual improvement in consumer sentiment, in consumption across our beverages and ice creams. Gihan will talk about that as we go into the details of the quarterly results. Tourism is very encouraging. Each month has been better than the previous month. We have been using 2018 as a benchmark, and the month of October, where we saw about 110,000 tourist arrivals, was just over 70% of what we saw in October 2018. Looking at the forward bookings that we have for our hotels, for the Cinnamon group of hotels, and through our inbound business, we expect that the winter season starting in December will be close to normal, close to what we saw in the winter of 2018-2019. That is both in terms of hotel occupancy and room rates in US dollars. On our key initiatives on Cinnamon Life, we mentioned in our quarterly statement that we have entered into an MOU with a leading gaming operator. The design work for the fit out and equipping of the gaming area has commenced, and we expect that we will make further disclosures as we finalize the final lease agreement. As we have been saying, the gaming area will be operated by a third party where we will lease it out for a fixed and variable rental, and the operator will invest in the fit out and equipping of the gaming area. The apartments and office tower, of course, are completed and have been handed over to the buyers and the tenants. The hotel, the mall, and the gaming area, we are looking at operations commencing towards the end of 2024. On the West Container Terminal, construction is progressing very well, and we are on track for completing phase 1, which will begin with a capacity of about 1.6 million TEUs in early 2025, around February 2025, and full completion in about a year after that, in early 2026. There was an announcement yesterday on the funding, the financing for the project, where the Development Finance Corporation of the US has committed to fund the entire debt component of the project, amounting to about $550 million US. So with that, I will hand over to Gihan to run through the details of the quarterlies, and then of course we'll both be here for questions after that.
Thank you very much, Krishan. So we'll move on to the presentation on the Q2 performance. For the quarter ended 30th September, that's Q2, the EBITDA of the group was at roughly 8 billion rupees, down around 13% from last year. So if you look through the various sectors, and I'll talk you through each of the individual businesses as we go through the presentation. But as we saw even with Q1, the drop actually stems mainly from our transportation business, where again, just to remind you, Q2 last year as well as Q1 last year, we saw the transportation business having an exceptional performance driven by a couple of factors. One was with the steep depreciation of the rupee value of the business, which is essentially a dollarized business, increased significantly. Whereas this year we've seen the rupee appreciate roughly around 15%. So on a dollar to dollar basis, on a conversion, we've seen a slight decline. But apart from that, the bunkering business last year had an exceptional Q1 as well as Q2 with high volumes, as well as global oil prices were high. So as a result of that, we saw an exceptional performance. So this year's performance is more, I would say, a normalized performance. But if you compare it against last year, we've seen that decline. But on a more positive note, if you look at across the rest of the main businesses, the consumer foods, retail, leisure and financial services, we've seen profits grow, and EBITDA has grown, as you can see, and as we'll go through the rest of the presentation. This is just a snapshot of the cumulative EBITDA for the first half. So as a result of course, the Q1 performance as well, we've seen EBITDA down. But here again, as you can see, a large part of that decline actually stems from the transportation business. This just depicts the quarterly movement of EBITDA. I won't spend too much time on this particular slide, but you can see in terms of the numbers, there's some seasonality in Q3, Q4, but at a sort of run rate of about that 9 billion is where we've been running at. So Q2 is slightly lower than that, but overall we're sort of maintaining that. If you look at the bottom of the screen, you see the exchange rate. So from last year at this 365, those sort of levels, we've seen the appreciation of the rupee, where at Q2 we were at about 320. So that's the appreciation I spoke of, which has had a negative impact on the dollar businesses, that's transportation, as well as to some extent the leisure business as well. Just getting into a little bit of detail on the finance cost for our businesses and the group. So this particular quarter, as we disclosed in our financial statements as well as a chairperson's message, we had a change in the functional reporting currency for our Cinnamon Life project, and I'll talk you through a little bit on that. So if you look at our numbers, you'll see the total finance cost increased quite significantly to 6.8 billion, but within that is contained a forex loss, a translation loss, a non-cash translation loss of around 2.1 billion, stemming from the $225 million loan that we have at Cinnamon Life. I'll talk a little bit more about that, but before I do so, I'll just explain the rest of the reconciliation we've shown here. So we also have the convertible debenture from Fairfax, and if you look at that, Q2 last year is when we had the debenture coming in around mid-August. So we had the debenture and the interest for around 1.5 months of that quarter, whereas this year we have the impact for the full quarter. So that's the difference that you really see from the 460 million last year to 990 million this year. So if you adjust for both those impacts and reconcile it, we've seen our finance cost move about 10% and not as sharp as what the headline numbers would show you. On Cinnamon Life itself, I think we have a slide later on, so I will maybe talk about the forex loss and the translation and the rationale for that when we get to that. This just shows you the finance cost over the quarters. So as we've said before, with rupee interest rates declining, we're starting to see that benefit come through to some of our businesses, particularly the businesses that have rupee debt funding. So if you look at our transportation business, consumer, retail, you can see compared with, if you just look at Q1 to Q2, you're starting to see those declines come through, and as a result of that, the total finance cost adjusting for the forex loss at Cinnamon Life, that translation, we've seen our finance cost from Q1 to Q2 starting to decline. And as you can see on the screen, the prime lending rate, the weekly prime lending rate, what's averaged roughly around 21% for Q1, has now declined quite materially to around 16%, which is the average for the second quarter. And now that rate's even come lower. Looking at our PBT, there may be some questions around this, and that's why we wanted to again show this reconciliation. So at a headline level, the group showed a loss at a PBT level compared to last year, which was at a 2.5 billion. But as I explained before, we have the forex, the translation of the Cinnamon Life loan, which is at 2.1 billion, as well as the interest expense on the convertible, which the conversion window actually gets opened out from February 2024 onwards up to August 2025 onwards. And we expect that that debenture should get converted within that window. But for the moment, the interest expense on that is reflected in our quarterly performance. So if you adjust just to show what is a more normalized level, then you'd see our performance is pretty much in line with what we saw last year. It's a very marginal decline in terms of the PBT adjusting for these two impacts. Just looking at our balance sheet indicators, our overall debt levels, excluding leases and the debenture, it's at around 220 billion rupees, which is a slight increase from where we were at the end of Q1. Our cash is at around the same level, but as we've deployed some cash into Cinnamon Life during the quarter, we've seen our net debt increasing slightly from the 111 or 12 billion that we saw in Q1 to around 120. So about a 10 billion rupee increase in the net debt. But as we've said before, overall in terms of our net debt to equity, we are quite comfortable at around the mid-30s. In terms of some of our ESG indicators, because of the group revenue, the decline that we saw, and that decline largely stems from the decline in revenue on the bunkering business because of the reduction in base oil prices. So as a result of that sort of more of that base effect, we've seen some of the indicators like the carbon footprint on an efficiency basis increase, but we expect that to be a temporary phenomenon as we move into the next couple of quarters. Moving on to our transportation business, if you look at just the progress on the WCT, the construction, Krishan already spoke of where we are with that. You can see the progress we've made from last year, November, so just over under a year, the type of progress we've made. All the main contracts connected or related to phase one have now been awarded. The construction of the quay wall is progressing, and as Krishan mentioned, the EFC has committed to finance the project with a loan, so with the entirety of the debt funding. Looking at the transportation business itself in terms of volumes, we've seen volumes at the port of Colombo grow around 8% and SAGT grew around 10%. So overall, total throughput increased, but we've seen a slight change in the mix, a decline in the domestic numbers, with all the fiscal consolidation measures and the contraction of the economy. We've seen the domestic volumes fall from around 12% to 10%. But overall, as you can see on the slide, we've seen total volumes increase. So the main impact comes from the appreciation of the rupee, as well as a decline in some of the ancillary revenues, which is what has affected profitability together with that mix change I spoke of. The bunkering business, as I mentioned before, we've seen more of a normalization of those volumes that we saw last year, Q1 and Q2. We saw reasonable volumes coming from fuel sales to the domestic market as well, because of the crisis, the economic crisis that was ongoing. The government opened up the local fuel sales for bunkering providers. So we benefited by that volume and the margins as well. So we've seen that come off, as well as overall fuel prices coming off in the market. So the combination of that meant that we've seen a decline. So whilst we've seen a 25% decline in volumes overall, that's also because of the local fuel sales. And if we exclude that, then the volume decline is at around 11%. Moving on to our consumer foods business, as Krishan mentioned, we've seen a recovery or pickup in consumer spend and sentiment. So we're seeing a sort of positive momentum starting to build up. And if you look at the numbers, you'll see that in our volumes, our carbonated soft drinks volumes have grown 5% in the quarter compared to a decline of 3% in Q1. And frozen confectionery, the ice creams business, has seen a marginal decline, but that again is quite a strong improvement from the 10% decline we saw last quarter. Quite positively, we've seen the margins of the business. As we said, we were expecting the margins to have sort of really reached that sort of trough in Q3, Q4, and we've seen that gradual improvement in margins. And in Q2, as we've expected, with the input costs coming down, plus the price increases that we had taken, we've seen our product margins actually recover to almost very normalized levels. And with the volumes also recovering, we've seen overall EBITDA margins improve quite substantially to around 15%. This was mainly driven by our ice creams business, whilst beverages also saw our gross margins improve. We did have some one-off spend on trade marketing, advertising and promotions that were undertaken as the market started seeing more of a normalization. So as a result of that, we did see some impact, but despite that, we've seen overall EBITDA margins in the business improve, and that's quite promising looking forward as well. Just looking at some of the prices of our raw materials. This is a slide we've been showing over the last couple of quarters. And as you can see here on the chart on the right-hand side, we continue to see that sort of decline on some of these key inputs. And that is what has helped or benefited us. On the other side, we've seen our energy costs going up a little bit with the revisions in the electricity tariffs that have happened in the country. We've had 2 revisions and a third one was just announced as well. So as a result, we've seen the energy costs going up in particularly our consumer supermarkets business. If you look at our ice creams business, the energy cost is a little more material. So you've seen that sort of as a proportion of our total cost of sales going up from around 4% to 7%. But despite that, we've seen all the other input costs come off quite materially, and that has been quite helpful in terms of the recovery of margins that we have seen. Moving on to our retail business, again, like we've seen before, our same-store sales, we saw double-digit growth at around 10%. As we've expected, we've seen ABVs coming off. Headline inflation in the country has come off very significantly. Now we're at sort of single-digit, very low single-digit levels. And we've seen price reductions in some key items as well. And as a result of that, we've seen ABVs coming off very marginally, but that was a trend we were witnessing even in Q1 from the type of growth that we saw in ABVs. But I think on a positive side, we've continued to see same-store footfall growing. So in Q1, we grew at 15%, and in Q2, we grew at around 10.5%. So I think that continued penetration and increase in footfall that we've been seeing has helped drive overall revenue. And we've seen that translate to EBITDA margins as well, where from last quarter to this quarter, we've seen a marginal improvement. Against last year, we've seen a slight decline. We've spoken of some of the cost impacts or increases. In particular, like I mentioned before, the electricity cost increase is something that has sort of impacted everyone across all industries. So if you look at just our consumer and retail businesses alone, we've seen around a 300 million rupee increase in our electricity cost if you compare last year Q2 to this year. So it is quite a, whilst the government needs to take those measures to address some of the fiscal imbalances, it has had an impact. And whilst we've taken a lot of actions to, look at our productivity in terms of electricity usage as well as renewables, it still has had an impact. In terms of retail, I think I already spoke of some of these factors, but if you look at ABV, if you look at Q2 last year, we were running at around 70% inflation in the country. And if you look at this year, we've seen inflation actually, almost flat. So that's where you're seeing that impact on ABV. But like we said before, the same-store footfall has continued to grow, and that's been quite a positive. Moving on to our leisure business, we've seen arrivals continue to grow. Of course, we are in the off-season, and as Krishan touched on earlier as well, we see a very positive forward bookings momentum as we head into the peak season, and we expect these numbers to be close to the pre-pandemic numbers, and that's the expectation. So we are right now in terms of the calendar year at over 1.1 million, and with the type of outlook that we see for November, December, we expect things to start normalizing heading into the peak season and heading into next year. In the Maldives, the numbers continue to be quite strong, but as we had disclosed in our chairperson's message, we are seeing a slight change in the mix of arrivals into the Maldives, and this has had an impact particularly on the sort of star class segment of hotels. So whilst the overall numbers have come in, we've seen a lot of inventory opening up with some of the guest houses in the Maldives, and those guest houses are attracting naturally a slightly different segment. So whilst the overall headline number of arrivals has sort of shown growth, if you look at what is actually coming to the star class hotel segment, we've actually possibly seen a decline in the numbers, and that's what has sort of put some pressure where the ARRs have not grown as much, and the occupancy also has not picked up as much. Overall, if you look at the trends that we've seen in our occupancies, notably we are seeing a strong pickup in Sri Lanka. So both the Colombo hotels and Sri Lankan resorts, we've seen that pick up. Maldives has been sort of by and large flat, despite what I mentioned. And I won't go through each of the numbers here, but if you look at the Colombo hotels, you see the occupancies improving both in Colombo and Sri Lanka resorts. In the Maldives, you've seen the numbers being flat with the ARRs coming off slightly, and that pressure is what has translated to slightly lower EBITDA margins in the Maldives. But in Sri Lanka, we've seen a very positive and strong recovery of the EBITDA, which ultimately has meant that we've seen a slight growth compared to last year. With Cinnamon Life, progress has been very strong. We've sort of done all the key testing of things like fire and all the other key utilities, and those have all been sort of passed successfully. In terms of design and the fit out of the rooms, we are near complete on over 650 rooms. So we've made very good progress on the fit out and completion. Krishan already spoke of the status on gaming, so I won't get into that unless there are questions that come up during the Q&A session. On Cinnamon Life itself, I'll just take a few minutes to explain the change in the functional reporting currency that we adopted for Waterfront Properties, which is the holding company of Cinnamon Life. So as you all know, we've had this dollar loan, $225 million loan at Cinnamon Life, which was a refinance loan back in December 2021, a 5-year loan, more heavily back-ended and for repayment due in December 2026. Now, as we funded this project initially, and the cost structure of the project, the capital structure of the project was in US dollars, we were accounting for this project, and the functional currency of the project was in US dollars. So as a result of that, we had a natural hedge where the assets and liabilities were both recorded in US dollars. Now, as we head into commencement of operations of the project next year, we would have had a situation where we would have had to transition the functional currency to rupees, given the current the foreign exchange regulations in the country, where settlement, whilst we can price and denominate some of our revenues would be in dollars, some of the settlements would have been in rupees, and as a result of that, we would have had to change the functional reporting currency to rupees at some point of time in the next couple of quarters. So the decision that we took was to make this change now, when the rupee was somewhat stronger. So at the point of time of conversion, it was at around 315 rupees. And we felt that converting at that lower point would mean that what we convert and translate as a carrying cost in rupee terms of this project in our balance sheet then would be translated at a lower rupee value, which of course in the longer term in terms of our return on capital employed and so on would help and translate to a better number because we are translating it at a lower value. Now this also means going forward then that number won't keep increasing depending on the exchange rate, and that number gets locked in as of what we have converted right now. The flip side to that, of course, is that then by moving to a rupee functional currency, the liability that we carry in terms of the debt is subject to the exchange fluctuations, and that is what we have witnessed in this quarter. So whilst on average, yes, the Sri Lankan rupee may depreciate, we felt considering both factors of translating the carrying value of the asset and of course the impact of the exchange, which we think is more of a transitionary nature because we will pay down this loan. We can also change the mix of the loan from what is now dollars to a mix of dollars and rupees. And of course, the project itself will generate US dollars as we commence operations. So we will have that natural hedge from operating cash flows as well. So just wanted to explain the rationale for making this decision and why the timing of it was done now. I think moving on to our property business, we've seen good traction with our Ryzen project. So we've seen sales pick up, and our monthly inquiries and the leads and conversion to sales has been quite promising. With Cinnamon Life, we have not seen sales progress as much as we've sort of expected, and we've indicated before. We will stay patient on this. We expect to see that things will start getting better, particularly with further announcements due on gaming as we sort of move forward on that, as well as when the project gets closer to completion. In our property business, we launched a new project in our suburban segment. This is a land that's out of Colombo, close to adjacent to the expressway, the airport expressway. So we have 6 acres of land, and that's what we are developing. That particular land, like I said, is adjacent to the airport expressway and has very good connectivity to Colombo. So we believe this is a segment, and this particular location can and will take off, particularly with the development of the connection from the end of the expressway that comes to the heart of the city, from the edge of the city that will take us to the heart of the city. So access into Colombo would be maybe under 30 minutes, and we believe there's quite a strong value proposition for this particular development, which will be at a different price point given the value proposition that we have. Finally, on our financial services business, we continue to see strong growth both in our insurance business as well as Nations Trust Bank. In the insurance business, we've seen GWP growth strong at about 15%. Profitability also has seen strong growth. With the bank, despite rates coming off, we've seen with the asset liability management, NIMs have still remained quite strong. And ultimately, we've seen strong profit growth. The cloud that was there over the banking and insurance industries with the domestic debt restructuring or optimization has now fallen away as well. So both businesses from a capital standpoint were anyway well capitalized, and we see both these businesses doing well in the next couple of quarters to come as well. So that concludes the presentation. Now we will open it up for questions. Once again, to remind you, if you have any questions, please enter it in the Q&A tab at the bottom of your screens. Krishan, we spoke, you touched on the forward bookings for Sri Lanka. Just any comments on how we see things even beyond just the immediate winter season, and how we expect tourism to recover and contribute towards the economic recovery as well heading into calendar year 2024?
Yes, we remain very positive about the tourism potential for Sri Lanka. And prior to the incidents on Easter Sunday in 2019, we were expecting tourist arrivals to grow at 10 to 20% annually, at least. And in 2018, the country achieved about 2.3 million tourist arrivals, and we thought we could achieve 4 million or 5 million within a few years. If you look at countries like small island of Bali in 2019 pre-COVID, they had over 7 million tourist arrivals, and Vietnam had 18 million. Cambodia had 5 or 6 million. So we remain very positive that given a normal environment, that tourism will go back to that growth trajectory that we were expecting to see prior to 2019. So, and especially given the proximity to India, which is the fastest growing big economy in the world, and the kind of outbound growth in outbound tourism that you're seeing from India, that we will see very strong growth in tourist arrivals.
Krishan, staying with leisure, do we see a mixed impact to the Maldives occupancy going forward as well? I think I touched on it during the presentation in the coming quarters, and how is the year-on-year recovery in ARRs in the Maldives?
Yeah, so as we discussed in the summer, although overall numbers have improved, we have seen the country has seen some weakness from the higher end markets. So the long distance markets, possibly because of the high travel costs. And of course, China, although China has opened up, China was the single largest market into the Maldives prior to COVID, and the recovery from China has been slow. Looking at the winter season, China is still not recovering to normal levels, and our view is that it will take some time. But the long haul markets, the European markets, are seeing a better recovery. So the mix in the winter will be better than what we've seen in summer, and we expect that the mix will keep improving. The long haul markets will keep improving, and China should also recover.
Okay, thanks, Krishan. There are a couple of questions just in terms of LMS and the volume drop, even excluding the local supplies, why there was a volume drop or whether there was a market share loss. No, we have not lost market share. It's just that, as I explained earlier, last year we saw exceptional volumes. So there were exceptional margins, as well as global fuel oil prices were high. But apart from that, volumes were also high in the region. So that has also normalized. But it's certainly not a case of LMS losing share. There was also a question about a bulk of the supply into the market coming from Hambantota. So yes, there is the supplies are coming in, but that does not mean that we have lost market share. So it's a question of where one sources your goods, whether you directly import or buy cargo domestically. But that still does not mean that we have lost share. It's more for the reasons that I explained earlier. There is a question about the margins in the consumer business, as well as the impact of the sugar tax hike, how that would impact the ice creams and beverages cost of productions. We will naturally need to monitor the impacts. We have the upcoming budget as well, but taking into account some of the impacts of the electricity increases, sugar tax increases, and so on, we will need to see what type of actions we will need to take, and if further price revisions are necessary. It would be likely, particularly on the beverages side, that we will need to take some price revisions. But as I mentioned earlier, the positive is that we've seen the margins improve quite significantly as well. So the product margins have recovered, but taking into account all these other actions, and as we've done last year as well, we've been quite keen to ensure that we don't see too much of margin erosion, and we try to recover that quickly. So it's something we'll need to monitor and take action accordingly, and we'll see if there are any other impacts that need to be considered when we have the budget as well. There's also a question on whether some of the products are VAT exempt, like the ice creams. In our business, these are not VAT exempt. So of course, with the VAT increase, or the proposed increase of VAT going from 15 to 18% effective from 1st January 2024, all that, like I said earlier, we'll have to just consider, what we need to do to manage margins. Krishan, there's a question that rumors are rife that VAT will be imposed on cell phones and many other items in the upcoming budget. There's a question whether we have increased our inventory levels in anticipation and whether there's a change in the strategy. I think that's relating to our retail business, not the supermarkets, but the office automation business.
Yeah, no, we haven't built up inventory, certainly, but I think all exemptions, barring a few, are expected to be removed. So it's not really a rumor. I think all exemptions will be removed. And the plan, what we've been told is it will be from the 1st of January. That is the expectation. So, then there is no change in strategy. The concern for this business, for the mobile phone business, is the grey market, which affects all our competitors in the formal market. So in terms of competing in the formal market, there really is no specific change of strategy.
Krishan, there's a question on our opinion on the introduction of the minimum room rates and how one should think about the ARRs and the impact for the city hotels going forward.
Yeah, it's, our view was that it should be left to market forces, especially at a time when occupancy in the city overall was just at 50%. So our view was it was more about filling the rooms at the best possible price, and perhaps when occupancies were higher to look at some kind of minimum rate. But our preference was to leave it to market forces. It's too early to say what the impact would be. It was just introduced very recently. In a couple of months from now, we would have a clearer picture of how the minimum rates is impacting rates at our hotels and in the market generally. I think the risk with the minimum rates is that the MICE market, where in the region you're seeing rooms and being offered to the MICE market at very competitive rates, that with the minimum rate plus the taxes and service charge, that Colombo may not be competitive. So we will have to see how this pans out over the next few months.
Thanks, Krishan. There are a couple of questions on Cinnamon Life in relation to the timing, in terms of whether the plan is to open the hotel and gaming at the same time, or would the hotel open sooner, as well as there was a question on, I think, a little more specific timing on the gaming and when we may hope to get that operational.
Yeah, the plan for the hotel opening is August next year, and the gaming, ideally we would like to open at the same time, but I won't commit to that timeline. It could be there could be a 1 or 2 month gap between the opening of the hotel and the opening of the casino. But both will be towards the end of 2024.
A couple of questions on, maybe I'll take this, the total cost for Viman and the funding of the project. So as we've done with a lot of our projects here, there is no outlay, and I should have mentioned that, in fact, because this is existing land that we have, so it's actually monetizing the existing land back. So apart from the profitability profits that we expect from the project, we will actually be then recovering and monetizing the cash value of the land as well. So overall, that would be very positive from a cash flow generation standpoint. The total project has around 400 units, the first phase. So we've broken it into phases and it's in modular form. So the first phase will be just over around 110 units. And we will start construction and actually mobilize only once we receive around roughly 65% of bookings. and we are already almost close to that number. So we, there's great traction on this project. And as I mentioned, because we are sort of looking at it on that pre-sales model, it's de-risked. And whilst there can be some form of bridging finance just to mobilize things, there is no investment as such from the group, and it's really monetizing the land bank that we've had. So as we've said before, given some of the lands that we have, our plan over the next sort of 5 to 7, 10 years will be to monetize these lands and ensure that we get a return on it. Staying with property, there was a question in terms of Cinnamon Life and the number of units. So there has been a decline if you look at the number of units that we had mentioned as sold before and what we are listing as sold now. So we've been following up on some of the collections, and whilst we've received a lot of the collection, then there has been no issue. We've been quite stringent now in terms of enforcement, and as a result, we've actually cancelled some of those units. It does not mean there's a refund. Those sales still remain technically as sales, and we will move those on to other buyers, and the collections that we have remain with us. But that is why you see that reduction in the number of units. There's a question on retail in terms of how many outlets we are planning on opening for the rest of the year. We were looking at maybe about 5 to 8 outlets in total for the year. And as we said before, we still believe that the long-term potential for expansion of outlets is very much there. The density of outlets in the country, the footprint can increase. Though we slowed down quite consciously in the last 18 months or so, given the financial crisis, we are now getting back on to expanding our footprint as we see a stabilization and recovery in the market. In terms of the DFC loan, there's a question on the cost and how the structure of it would be, and whether the group will take on our share of the loan. It is actually a project loan that sits in the project company. In terms of how we account for the project company, that's CWIT, the Colombo West International Terminal, we will be accounting for that as an equity accounted investee, given our 34% stake there. So it's not a line by line where we will be consolidating the debt. So there is no share of debt that comes in, and it doesn't affect our blended cost of debt. Right now, we can't get into the specifics of the terms and the rates on the loan. Whilst there are agreements on some of these things, the final agreements are yet to be finalized, and we will make disclosures accordingly at the right time. But overall, just to reiterate, this debt would sit in the project company and would not be consolidated into the JKH Group consolidated numbers. Krishan, there's a comment and a question saying the reviews on Valifushi seem very positive, and then to comment on whether we would be looking at any new hotels on the horizon.
There is nothing specific in the horizon in terms of new properties. Yes, the feedback on Valifushi has been very positive. And we are looking at ways of positioning it a little differently, possibly, given all the good feedback. There is nothing in the pipeline that I can talk about in the hotel sector in terms of new acquisitions or new management contracts. We have been asked why we are not doing more in the Maldives. I think the response to that is we already have 4 properties. So if we were expanding, we may look at a different new country, so that we don't concentrate too much resources and risk in one country.
There's a question, Krishan, I think with the recent announcement by CIC in terms of the CIC equity accounting for JKH, just some clarity in terms of whether there's any other reason for that to happen, and whether there were any JVs or anything like that is the question.
No, there is nothing else beyond, I believe, beyond what was disclosed, which was the intention of that was to be able to equity account their share of the shareholding in JKH, and there is nothing else beyond that.
There's a question on the group dollar cash position. So if you look at, as we've said before, the main two sources of our dollar liabilities is the Cinnamon Life loan, the $225 million, and the IFC loan at the holdco of $175 million. So at the holdco, the $175 million is hedged because we carry the cash on the other side as well, and that's been a position we've taken. Of course, as we infuse some funds, that position can dilute. Before, as we've said, the $225 million was hedged to the extent that the functional currency was in dollars. But as I explained in detail, because we've now shifted to rupee terms, there is an exposure there, but that we expect to be more temporary over the next couple of years, given the cash generation that we'll see from the project, as well as the fact that the loan will start getting paid down. I think I sort of touched on this, but there's a question on the margin, possible contraction that we may see in consumer with some of these rising input costs, and whether we have sufficient inventory to handle this. So yes, in terms of our inventory that we carry on things like sugar, we have inventory of about a quarter, so there'll be a lag effect in terms of a margin impact despite the increase in some of these prices. But having said that, and like I said before, we'll need to look at the collective impact on some of these things and take a call. But as we've done before, maintaining margins has been something we've been quite stringent about, and we will take action if needed. In the Kiehl's supermarket business, whether we have plans to increase the product offering in terms of the private label. That's been a strategy we've been following over the last couple of years, and particularly in the last 12 months or so, with some of the import restrictions, we've upped our direct import strategy, looking at providing value for our consumers by offering alternate products given some of the restrictions and limitations of the products that were available. So that's been very much a part of our strategy, and if we've ramped it up as well, and that's something we will continue to do. It naturally has a positive impact from a margin perspective, but as importantly or more importantly, it has an impact in terms of how we serve our customers and provide a value to them as well. There's a question on our capex plans for the next 2 years or so. So I think the main capex that we are seeing is the Cinnamon Life project. So the project, we've been at about 110 million more to go. Now we are at about maybe $90 million or so more of capex to go with Cinnamon Life. With the West Container Terminal, we've already infused around $35 million, and we have another maybe $40 million or so more to go, which will be over the next sort of 12 to 18 months that funding will go in. So those are the two main sources of our capex. Those are funded, as we've said, because with the cash that we carry, as well as, of course, the cash generation capability of the group. The rest of the capex, of course, would be the standard capex in terms of store expansion, maybe 8 to 10 outlets as we head into the next year, as well as some expansion capex if the volume trend that we're seeing continues, but those will be largely self-funded by the businesses. I think there's a question again on the FNB, about demand contraction that we may expect. It's a little difficult to, predict how things will pan out. But as we've shown, we've seen positive momentum over the last couple of quarters from the sort of lows that we saw. We've seen a pickup. So a lot will depend, of course, on how consumer sentiment evolves over the next couple of quarters. But based on the current trends we are seeing, we hopefully should see this momentum continue. Yeah, I think that's all the questions we have for today. We are almost out of time as well. So that leaves me to conclude today's proceedings. I'd like to thank you very much for joining our Q2 Investor Relations webinar. This webinar, the recording of this will be uploaded on our website shortly. So if anyone needs to review it again, it will be available. Thank you very much once again for joining the webinar. Have a pleasant day. Thank you.
Thank you. Thank you, everyone. Thanks.